The digital heist began not with a masked robber and a gun, but with a keyboard in a darkened room. In early February 2016, sophisticated cyber criminals, believed to be linked to North Korea, infiltrated the computer systems of the Bangladesh Bank, the central bank of one of the world's poorest nations. Their target was not the bank's own vaults, but its account at the very heart of the global financial system, the Federal Reserve Bank of New York. Using meticulously crafted fraudulent orders on the SWIFT, Society for Worldwide Interbank Financial Telecommunication Network, the secure messaging system that coordinates trillions of dollars in daily transactions between banks, the hackers initiated a series of transfer requests. Their ambition was staggering. They attempted to steal $951 million in one fell swoop. Most of the requests were blocked, largely due to a simple spelling error, foundation instead of foundation, that raised alarms at the New York Fed. But 5 transactions, totaling $101 million, slipped through. Of that, $20 million to a Sri Lankan bank was recovered after another clerical error triggered suspicion. The remaining $81 million vanished into the ether of the international banking system, beginning a dizzying journey that would expose the fragile links in global finance and turn the Philippines into the epicenter of one of history's most audacious cyber heists. The stolen funds did not simply disappear. They were routed with precision to a single destination: the Philippines. The hackers had pre-positioned a network of accomplices and exploited specific vulnerabilities within the Philippine financial landscape. The $81 million was split into 4 tranches and sent to 4 fictitious bank accounts at the Jupiter Street branch of Rizal Commercial Banking Corporation, RCBC, in Makati, Manila's financial district. These accounts, opened months earlier under obviously fake names like William So and Michael Cruz, were seemingly dormant, waiting for their moment. They were under the control of the branch manager, Maya Santos de Guito. When the funds arrived from New York, de Guito executed the next critical phase of the plan. Instead of the money sitting in these accounts, where it might be frozen or traced, she authorized its immediate conversion into Philippine pesos and subsequent withdrawal. But this was no ordinary withdrawal. The equivalent of $81 million in peso notes would fill trucks. The solution was both brazen and revealing. The money was deposited into accounts belonging to a single, high-stakes Chinese-Filipino casino junket operator, Wei Kang Shu. By funneling the stolen billions of pesos into the casino ecosystem, the launderers exploited a massive loophole. At the time, Philippine casinos were explicitly exempt from the country's Anti-Money Laundering Act. They were black boxes, where vast sums of cash could enter, be converted into chips, gambled minimally, and then cashed out as clean casino winnings, with little to no paper trail for authorities to follow. The stolen Bangladesh bank funds were washed through this system with breathtaking speed, moving from RCBC to casino accounts, and then likely dispersed further through remittance centers, shell companies, and the purchase of untraceable assets. The role of Maya Santos de Guito, the RCBC branch manager, transformed this cyber theft into a tangible financial crime on Philippine soil. She was not a faceless hacker overseas, she was a local banker with authority and access. Her conviction in January 2019 on 8 counts of money laundering made her the first, and for a long time, the only individual to face justice for the heist. The court sentenced her to a total of 32 to 56 years in prison, with each count carrying a penalty of 4 to 7 years. In its ruling, the court found her actions deliberate and central to the crime's success. She had opened the fictitious accounts, facilitated the massive conversions and transfers, and coordinated with the junket operator, all while ignoring blatant red flags. De Guito maintained she was a scapegoat, following orders from higher-ups at RCBC, but the evidence against her was damning. The bank itself was slapped with an unprecedented 1 billion pesos, roughly $20 million, fine by the Philippine Central Bank, Bangko Sentral ng Pilipinas, BSP, for its failure to prevent the movement of the stolen money. The scandal devastated RCBC's reputation and led to a top-level management overhaul. De Guito's conviction provided a measure of accountability, but it also highlighted a disturbing narrative: that a single mid-level bank employee could be the critical linchpin in the laundering of a nation's stolen reserves. In the painful aftermath, the Philippines was forced to confront its role as a financial crime facilitator. The international pressure was immense. The country risked being placed on FATF's blacklist, which would have crippled its banking ties with the rest of the world, making international transactions prohibitively difficult and expensive. To avoid pariah status, the Philippine government was compelled to enact sweeping reforms. The most significant was the closure of the casino loophole. In 2021, after years of political wrangling, President Rodrigo Duterte signed an amendment to the Anti-Money Laundering Act, finally requiring casinos and real estate developers to report suspicious transactions to the Anti-Money Laundering Council, AMLC. The central bank, BSP, also dramatically intensified its oversight, imposing heavier fines on negligent banks and pushing for stricter Know Your Customer protocols. For RCBC, the fallout was a masterclass in reputational damage control. Beyond the record fine, the bank had to embark on a long and costly journey to rebuild trust, implementing world-class compliance systems and publicly distancing itself from the Daguito era. The heist became a permanent scar, a cautionary tale studied in compliance departments worldwide. The choice of the Philippines as the destination for the stolen funds was a deliberate exploitation of a well-known vulnerability. For years, international financial observers had flagged the country's casino industry as a glaring loophole in its anti-money laundering framework. The $81 million did not just happen to end up there. It was directed there by criminals who had studied the landscape and identified its soft underbelly. Beyond the casino exemption, other systemic weaknesses were at play. The sheer volume of remittances from overseas Filipino workers, a vital part of the national economy, created a complex financial ecosystem where moving large sums across borders was routine and often lightly scrutinized. Furthermore, the culture within some Philippine banks prioritized client relationships and business generation over rigorous compliance checks, a mindset that a determined insider like Daguito could manipulate. The heist did not create these weaknesses, it ruthlessly exposed them to the world, revealing a financial environment where the rules could be bent for the right price. The international investigation into the heist became a masterclass in the frustrating limitations of cross-border cybercrime prosecution. While the digital fingerprints pointed strongly to the Lazarus Group, a hacking collective linked to North Korea's Reconnaissance General Bureau, attributing the crime with absolute, courtroom-ready certainty was nearly impossible. The hackers used sophisticated tools and routed their attacks through servers in multiple countries, creating a labyrinthine trail. North Korea, a pariah state with no extradition treaties, was effectively beyond the reach of international law. This left authorities chasing the money trail instead of the hackers, a trail that went deliberately cold in the Philippines. Mutual Legal Assistance Treaty requests between Bangladesh, the United States, and the Philippines moved at a glacial bureaucratic pace, hindered by differing legal standards and, at times, a lack of political will. The FBI and other agencies found their progress blocked by the same casino secrecy laws that had enabled the laundering. The heist, therefore, highlighted a grim 21st century reality. A state actor could execute a brazen financial attack on the global system and remain virtually untouchable, shielded by both its own isolation and the willing or unwitting complicity of weak links in legitimate financial networks. The long-term geopolitical and economic consequences of the heist extended far beyond the immediate loss of funds. For Bangladesh, a nation perpetually battling poverty, the theft was a devastating blow to its national prestige and economic sovereignty. It forced the government to implement austere measures to replenish its foreign reserves, impacting import capabilities and potentially slowing economic growth. The incident made other central banks and the Federal Reserve itself re-evaluate their security protocols for high-value transactions, leading to increased costs and delays in legitimate global money transfers. For the Philippines, the financial cost was immense. Beyond the record fines, the country faced severely increased compliance costs for its entire banking sector, as international correspondent banks demanded stricter due diligence. The threat of an FATF blacklist loomed for years, a sword of Damocles that threatened to increase the cost of remittances, the lifeblood of millions of families, and isolate the Philippine economy. The Bangladesh bank heist became a synonym for financial malfeasance, a stain on the country's business reputation that scared away legitimate foreign investment and tarnished its standing for years. The money may never be recovered, but the lesson remains. The safety of the global financial commons depends on every nation fortifying its shores, because in the digital sea, predators are always hunting for the weakest link. The broader context of the heist reveals its true scale. The $81 million successfully stolen was just the tip of the spear. The attempted theft of $951 million targeted Bangladesh's entire reserve holdings at the New York Fed. Had it succeeded, it would have bankrupted the central bank of a nation of 165 million people and triggered a financial and humanitarian catastrophe. The international investigation that followed was sprawling and frustrating. It involved the FBI, authorities in Bangladesh, the Philippines, Sri Lanka, and several other countries. While De Guito was convicted, the masterminds, the hackers who breached SWIFT, and their handlers remained largely in the shadows. Believed to be part of North Korea's notorious Bureau 121 cyber warfare unit, which uses stolen funds to finance the regime. The trail of the $81 million figure grew cold as it dissipated through Manila's casinos and beyond. Only a minuscule fraction was ever recovered. The heist, therefore, stands as a landmark event. It is the story of a digital age theft that exploited the intersection of high-tech cybercrime and old-fashioned, localized corruption. It showed how a global financial network is only as strong as its weakest national link. And for the Philippines, the $81 million Bangladesh bank heist was a brutally expensive lesson, a catalyst for a belated and ongoing struggle to clean up its financial system and shed its damaging reputation as a laundry for the world's dirty money.